Welcome to the 5 and 5 option trading series. We are making 5 videos over 5 days, roughly 5 minutes each, to teach you about option trading. This is day 5. Welcome to the final day. We're going to talk about some of the income strategies I like to use. This series is being created by the Weekly Option Podcast. Each week we explain 3 new trades that you can add to your account this upcoming week, and we discuss the results of the trades from the last show. Feel free to find us on iTunes, on Google Play, and on Stitcher. With that, let's dive into this video. So I want to take a look at buying options versus selling options, because a lot of people like to buy options because of the limited risk characteristics. You can only lose the amount of money that you put in when you buy an option. Well, the situation, though, is when you buy an option, you have to be right. You need to be right on 2 things. The timing, because that option has an expiration date. So you have to be right on the timing and the direction of the move. So if I buy a call option that expires in August, I need the market to move up during, either now or before August. If it does not, then I lose the money that I put into it, right? So there's a cash outlay right at the start, but there's minimized risk. With selling, time actually works on your behalf, because if the market makes that move up after the expiration date, it's okay, because as long as it didn't happen during that option time frame, the seller of that option gets to keep the money that was paid for the option. Also, don't have to be right on the direction. If I sell an option, I'm happy if the market just sits still and waits out time. It's awesome. And you get paid for entering the trade when you sell an option versus when you buy it. So most income strategies do involve selling options so that you receive money right from the start. Buying put spreads and call spreads, like I said, requires a cash outlay. And so people typically prefer to sell spreads when they're looking at creating income. And you sell those spreads because they have, very capped risk outcomes, but it still allows you to create a scenario where you receive money up front, and right off the bat what your upside and your downside is. You typically would choose to sell out of money strikes for spreads. So now we'll talk about iron condors. Iron condors are a very popular income strategy. You receive money, so you're going to sell these when you enter the trade. So this is basically taking 2 credit spreads and putting it together. The spread will have capped risk, right? We know our risk from the start, and it does not depend on if the market is going up or down to work. So what is a condor? It's when you sell a call spread and a put spread on the same underlying stock in the same expiration. The strikes are typically equidistant apart, meaning they are you have a $5 spread on the call spread, then you sell a $5 put spread. But you need the spreads to be the same value, the same maximum value, in order to maintain the risk that we're putting on. So assuming XYZ stock is trading for $27.50, we would sell the XYZ 25-20 put spread and collect $1, right? We'd buy the 20 put for a quarter, sell the 25 put for $1.25, so that's collecting $1. We'd also look to sell the 30-35 call spread and collect 95 cents. So that's, say you sell the 30 call for $1.30 and you buy the 35 call for 35 cents. That is collecting $1.95 for the iron condor. Our maximum gain then would be the $1.95 that we collected when we put the trade on. Our maximum risk, of course, is the difference between the strikes of any single call spread or any single spread. So that was $5, a $5 spread. We collected $1.95 to trade. So $5 minus $1.95 equals $3.05. So with credit spreads, we receive money right from the start of the trade. There are also some other income spreads that people will put on, like ratio spreads, where you sell more than one option to buy the closer to the money option. You can actually put in a great scenario where you lock in money right from the start, whether markets move against you or in your favor. People also will look to sell strangles and straddles, which were covered in the last video, versus stock. Debit spreads are something that we use on the show each week as well. A debit spread is when you actually buy a spread. When buying the spread, you do have to be right on the timing and the direction. So I typically choose in the money debit spreads so that the direction has already been confirmed, and it's just a matter of buying a spread at a lower value than the full value that I know the spread will mature into at expiration. So paying 50 cents for a spread that's going to mature at $1 is something I like to do. Key factors for trading options, of course, still remain intact. You've got your break-even point, your maximum risk or loss, knowing your maximum gain or reward, and knowing what kind of adjustments you're going to make. So it's important to understand how option risk change with each option that you add or take away from a spread. And that pretty much is going to be it for our 5 and 5. I went over on this video. But if you have any questions, please do email me at eric@theweeklyoption.com or head to our website, check out our podcast. We look forward to helping you learn and get active in option trading. All right. Hope you're well. Take care.